Hi, it's Elena Saradidis with Lamb Realty, and today we're talking all about mortgages, and I brought a mortgage specialist with me today, Elan from Mortgage Outlet.
Hi everyone, and thank you very much for having me. My name is Elan Weintraub. I'm one of the two co-founders of Mortgage Outlet, and as a little bit of background, Mortgage Outlet is one of the largest independent brokerages in all of Canada. We have over 150 mortgage agents and brokers, and we do over $1 billion a year in volume. But what that means to you is we offer great solutions, big banks like Scotia and TD, credit unions like Alterna, Duca, Meridian, even insurance companies like Manulife and Desjardins, plus many more.
So I just had a couple questions. When you first get a client, whether they're a first-time buyer or a first-time investor, what is typically the steps you take once they're introduced to you?
Sure, so great question. The first thing I do is I explain my role as a mortgage broker. And the way I explain what a mortgage broker is my role is to flawlessly understand my clients and then to offer them different solutions or different options, and then they choose what they prefer. So the example that, the way I would contrast it is if you contrast walking into your bank versus a broker. It's like walking into a BMW dealership. If you walk into a BMW dealership, they're only gonna sell you BMWs. They're not gonna talk that Audi is on sale or that Tesla has, electric power or that Kia is a cheaper option or that a minivan can seat 6 or 7 people. They're not gonna tell you that BMW has a safety recall because they're not gonna advertise all the negative news. So on the mortgage side, my job is to understand your needs. Oh, you're doing carpool every day with 6 kids. We should talk about a minivan. Oh, you're looking for something, Italian and sexy. We should talk about Ferrari. So my role is to give you all your options. And your role as the client is to tell me what option you prefer. You're the decision maker. So if you have 6 kids, I might say, well, let's go with the minivan. You might say, well, I still want the Ferrari. And that's 100% your point of view. So my role, again, is to understand the client and then to provide solutions to the client. Now, the funny thing is, I'm gonna build on my example here, but when you walk into a BMW dealership, you're walking in and you're just kind of like a retail client, whereas I'm doing hundreds of millions of dollars of business with all of my lenders. So we get better exceptions, faster service, and better rates. So pretty much across the board, we're gonna offer a better experience.
So are there any fees associated when it comes to working with a mortgage broker or going directly with the bank? What are the fees involved?
Great question. So 99% of the time, there are no fees. Where there would be fees is if you're buying a commercial property, or if you have very bad credit, like bankrupt or something like that. But we would be upfront and say, like, for this type of mortgage, there would be a fee. But I would say 99% of the time, there are no fees.
What is your definition of bad credit? Just so people know, what is a good credit score to have? What makes it easiest possible for you to be able to invest in the market?
You're on fire with your question. So, credit is actually, it's not as simple as like a 650 credit score or 700 or 750. It really depends on what you're trying to do. So as an example, if you have a 640 credit score and you're a first-time buyer and you've got a decent down payment and a decent job, you're good to go. If you're buying a rental property and maybe it's your 3rd or 4th rental property, a lender might not like a 640 credit score on some kind of investment. Or if you're refinancing to consolidate debt, they might not like it on a refinance, but on a purchase, it's okay. The other thing is, and this is again a really crazy scenario, but I could have 3 clients with a 650 credit score. One of them forgot to make a payment on their HBC credit card last week, and it was an innocent mistake, and they fixed it. Another one maybe had a really bad event 4 years ago, and they've been good for 4 years. And the 3rd person could just be consistently sloppy for 4 years. So the 650 in the first 2 scenarios, oh, I forgot to pay my HBC credit card or my Rogers and we took care of it, or like I had like a bad medical illness 4 years ago, that's very different than I've been sloppy for the last 4 years. So even your score in and of itself is not enough information to make the assessment.
Okay, so we talked a little bit about score. What else do you need when you're submitting a file to a bank or to a lender that you're going to require from clients to have?
Right, so we have three sayings at Mortgage Outlet, or three pillars. So the first one is called application and documents. The second one is it depends. And the third one is just do it. So the first stage is, again, flawlessly understanding our client, which we call application and documents. So we need proof of your income, your expenses, your liabilities. Are you separated? Are you divorced? Do you have student loans? Are you buying a property that maybe has a basement apartment and we're gonna, use the rental income? And the reason it's so critical to have application and documents up front, I have clients where they have 3 kids and they get child tax credit, and maybe they get $2,000 a month in child tax credit, and we're using that income to help them get a better mortgage. But maybe they have a 12-year-old and the 12-year-old is turning 13 soon, but they want a 5-year mortgage, so the child will be over 18. So it even gets to the point where I need to know how old my client's kids are, because it actually has a massive downstream impact. So the first stage, what do we need to know? Income, do you own any properties? Where's the down payment coming from? Your credit? We need to know everything about you. And again, we don't want to find out down the road that we helped you get a Ferrari and then it was obvious that you have 6 kids in your carpool. We want to know that up front. The next answer is it depends. Do you want a lower rate? Do you want a big bank? Do you want this or that? And that's where we provide our options and ultimately the client decides. And just to conclude, just do it is more of an internal motto where we obviously want to encourage our mortgage agents and brokers to succeed, go out there, be on camera, meet with different referral partners, go out and just do it, make the magic happen.
Okay, so something that I was going to mention is when you're purchasing a property or when you're a first-time buyer or an investor, you're looking at purchasing multiple properties. I usually tell my clients be very, very honest with whoever you're working with on what you want to get out of your real estate portfolio. So if it's, I want to buy one property and that's it, great for you, but things change, life changes. What happens if you want to buy a second property in the next 2 to 3 years? What product is the best product for you to get? What should you be doing if you know you want to build a real estate empire and you want to invest in multiple properties? Is there a certain product that you would recommend to them? Is there certain steps you would take to ensure that they can be successful in buying real estate?
I guess there's a lot to unpack there, but the first thing is just to be upfront with your mortgage provider of like what your goals are, so that it's like, this is what I want today, but this is what I want in 2 years or 3 years or whatever it is, so that again, they don't put you into the wrong product. I am a fan of variable rate mortgages. We could talk more about that. That in itself is a big topic, but they allow for a lot of flexibility. And again, depending on what your needs are, there's an expression in the mortgage industry, and I guess across business, you can have the lowest rate or the lowest cost. And as an example, if you're planning on becoming, scaling up and doing a lot of real estate, the big banks can be a lot better because by definition, they're big. They have a lot of products and offerings and they can deliver on the complexity, where sometimes the really, really low rate lenders offer one thing and that's all they do. And if your needs change, they might not be the best to do it. So if you're like, yeah, I'm just buying a property, I'm gonna live there, everything is great, that might be option A. But if you're more interested in scaling up, investing, a big bank might be a better option for you.
Now, if you are interested in scaling up and investing, would you recommend variable or would you recommend fixed?
So again, the second pillar is it depends. So first I need to understand everything about you. But in general, I do recommend variable. And the reason why is, again, in general, the penalty to break a variable rate mortgage is 3 months of interest. And to me, an investor, it's very important that you have flexibility because you could have another opportunity. You might need to sell the property. You might want to refinance it. And you don't want to have a $40,000, $60,000 penalty preventing you from executing your business strategy. So a variable rate mortgage definitely gives you, you pay a small penalty, it's a cost of doing business, but then you're unlocking equity, value, and your entire business plan. So definitely variable for investors.
So just full disclosure, Elan has worked on applications for me in the past. He knows that I tend to go variable all the way. I'm a huge fan of the BRRRR method, which is buy, renovate, rent, refinance. So when it goes to the refinance stage of investing in property, a variable interest rate is actually more advantageous just because we can pull out that money at a lower cost. So is there an interesting case that you've worked on recently where the paperwork wasn't perfect? What should you be doing to ensure that all the information that's given to you is the most accurate information? You're not going to run into any roadblocks when applying for mortgages.
Yeah, there always seems to, the best way to prevent that, and when I talk to my clients, the way I try to structure things is preventing issues, not solving problems, solving headaches, because this is way more stressful. And the example is, if it's a sunny day, put on sunscreen and you're done. Don't forget to put on sunscreen, and then you get a burn and you gotta put on aftercare and all that stuff. So the best way to prevent issues is providing the application and documents, again, stage one, so that we don't find out, oh, by the way, I co-signed for my sister's car, or by the way, I was gonna pay off my student loans and I never bothered doing it. If you have a solid foundation and we understand who you are, it helps us provide the right solutions, and then it's a smooth process. Where we, can get into challenges, and again, we spend a lot of time preventing all of this stuff, is that if something comes in and it's not exactly how we were informed about it or how it was disclosed, and then we need to figure out how to make it work.
I know that there's some negative affiliations with B lenders. What is the difference between an A lender and a B lender? Should you not be going B lender? Is there pros to going with a B lender? What are your thoughts on that?
Sure. So B lender is it's kind of a term that sophisticated people know. So I would call it an alternative lender, or more of a common sense lender. And really what they do is they're not as rigid as the banks. And there are 3 or 4 examples that I'll give you on what a B lender might do. So the first example is very simple. You might have a plumber or an electrician, and their tax returns show that they make $2,000 a year in profit. And in the meantime, these plumbers and electricians are making a lot of money. So what a B lender will do is look beyond your tax returns, and they'll look at your bank statements. Oh, you deposited $22,000 at the beginning of the month, and then $17,000 in the middle of the month. And they will look at common sense lending, and it's called stated income. So you've got all these deposits coming in. Let's look at what that income really is, not your $2,000 tax return, because you've probably got a great accountant, you're writing off all of this stuff. We're gonna look at the bank statement. So the first area that a B lender would look at is stated income. The second area would be, subprime credit or poor credit, and the reality is life happens. People get into car accidents, people, they have issues, and similarly on the credit side, they get laid off, they have a health issue, a divorce, maybe a business failed, and a B lender will give you the opportunity as a consumer to rebuild your credit. So your credit might not be good enough for a bank or a credit union, but it might be okay for a B lender, and you pay a little bit more. And the goal, and generally most B mortgages are 1 year, the goal is to sort of clean everything up, get everything ready, so that in a year you can go to an A lender or a bank, and in a year you're gonna go to those better rates. So they are a critical part of the mortgage process, especially if you've had some damaged credit or what have you. Now the third area, and this is very interesting, is almost the complete opposite of the first two. The third area is actually for some high net worth clients. And the reason a B lender can work really well for high net worth clients is you might have let's say a lawyer married to a physician, high income, lot of money, and they own 7 rental properties. Well, some of the banks might say, you know what, we don't really know if we want, you're becoming more of a landlord than a lawyer and a physician. We're not really interested. So a B lender will approve the mortgage, or the bank might say, we'll lend you $1 million, and the B lender might say, we'll lend you $1.4 million. And again, everyone gets hung up on rates, but I would rather pay a higher rate and keep $400,000 of my own money. So you literally have this common sense lending of stated income, tarnished credit, or high net worth people. I mean, another thing that some of the B lenders do that's really good is if it's a $4 or $5 million property, they might lend you the full 80%. Whereas a bank might want 75, 70, 65%. So they're more willing to give you a little bit more money, especially if you have good credit and a good profile.
Okay. So my next question has to do around first-time buyers. How much are you supposed to put down? How much do you advise putting down? And what are the tiers of how much you have to put down based on the purchase price?
Okay, so as again, first pillar is application and documents. Second pillar is it depends. So other things being equal, I always recommend 20% down. And the reason why is if you have less than 20% down, you are forced by the government to basically pay mortgage default insurance. And that's more commonly known as CMHC or Genworth, which is now called SAGEN, or Canada Guarantee. So you're gonna have to pay a higher fee for that. You're gonna pay $5, $10, $15, $20,000. So if you have 20% down, you're saving that $5, $10, $15, $20,000 fee. With 20% down, you actually can get a 30-year amortization as well by law, whereas with less than 20%, you need to, your maximum amortization is 25 years. Now, the reason this is important is with a 30-year am, your monthly payment is actually lower, and monthly payment is critical because you don't live in a 25-year mortgage, you live week to week and month to month. So if the 25-year am, your monthly payment is $3,000, but with a 30-year am, it's $2,500. It frees up $500 a month of your cash flow, which frankly, gives you a little bit of breathing room if there's an emergency or if you want to, the furnace breaks or whatever it is. So in general, I always recommend 20 years. Now, that being said, properties in Toronto are $1 million. So 20% is $200,000. Most people don't have $200,000 to put down. In that context, absolutely, you put 5, 10, 15% down, and it lets you get into the real estate market. And these are government programs that are designed to help Canadians buy real estate and own a home and build their families and their households. These are largely government programs. So if you don't have 20%, you should and can take advantage of these programs that lets you get into the marketplace.
Definitely. I think you touched upon a point of CMHC and a bunch of other rules. I've noticed when I'm showing properties that if they're under a certain square footage,
yes,
it's harder to get qualification, especially if you're putting less than 20% down. What's the square footage? What are the rules around it? How do we prevent our clients from getting into situations where it's uneasy for them or they have to get a co-signer or someone else to be on the application?
Okay, so again, that easily falls into category 2, which is it depends. Generally, so first of all, it depends on the city center. Is it Toronto proper, or is it outside of the GTA, or is it kind of 2 hours north of Barrie, right? It depends. The first thing is what's the geography.
So let's talk Toronto proper because
okay,
that's where we're going to find the smallest square footage at the highest price.
Yes. So the next question is, generally 500 is kind of a key number, 500 square feet. But is it a 500 studio or is there a bedroom? Is there a 450 with a bedroom or a 500 studio? So lenders will look at all of these things and insurers as well. But you asked another question. It's hard, you go so quickly, which is awesome. The simple answer is the best thing you could do before you make an offer on your condo is send the MLS listing to your mortgage provider. And that way they can look at is there a bedroom or is it a studio? What's the square footage? Is there anything notable on the MLS that would be worrisome? And it gives the mortgage professional the opportunity to confirm the maintenance fees, the heating costs, the property taxes. So the way you prevent, again, we're all about prevention and smoothness. The way you prevent this is by sending the MLS listing before you sign the offer to purchase. Now, something that we do all the time, as you know, is there's actually a condo blacklist. And there's a known list of buildings that have problems. And banks don't like them, credit unions don't like them. So you don't want to spend all this time negotiating and you've got good credit and good income, but then it's known that the condo has leaky foundation and parking, or the windows and the balconies are falling off. You can save yourself a lot of time. So I would check the condo blacklist as part of our due diligence even before you make the offer. And then again, of course, you're going to check with your lawyer, the status certificate, all of those wonderful things. But it's a good opportunity to run through the numbers so that when you run through the numbers, you have a confirmation of like where we are, does the property work? Because you can be an A-plus client, but if you buy a condo that's on the blacklist, and there was one time where the board of directors, the vice president treasurer was embezzling money, right? Like lenders are not going to want to lend on that. So you want to do all of that due diligence up front so that you don't start negotiating an offer and then waste a lot of time and have it all fall apart.
I definitely think that comes into play with who you're working with. I know personally I have a few condos in mind that I would never take my clients to, and it's because I know they're on the blacklist. They've either, the developer's gone bankrupt, or they have lawsuits against them that
are huge,
are going to prevent lenders from actually funding those developments. So we don't even look at those buildings or those areas just for knowing that fact. Now, another question that I had was, we talked a little bit about interest rates and going with an A or B lender, but where do you predict interest rates are going to go? Because I'm sure that's the hottest question of the year.
Yes. Well, there's a lot of talk about interest rates. There's a lot of inflation, whether it's on the news or people feel it. They go out, they buy groceries, they buy different things, and they're like, wow, things are expensive. So in my mind, interest rates are definitely going up. And I'm going to answer your question in two ways. What I would like to see and versus what I actually think would happen. I would love to see, I know this is going to be controversial, but I would love to see the government raise rates a tiny bit in the spring. And the reason why I say a tiny bit is just to remind people that rates cannot stay at historical lows forever. So, do a little, the expression tap on the brakes. And then let it run. And then 6 months later, 8 months later, do another tap on the brakes. Because the challenge with interest rates is if you hit the brakes too hard, everyone starts panicking. Like it just creates mayhem. So just a little tap on the brakes. That's what I would like to see, is like a couple taps, like very, very slow. Now, I follow all the banks and their economists. Scotiabank, actually, by the way, there was a huge jobs report yesterday. Employment is doing very, very well. Like all signs are pointing to like everything is really picking up. We're like showing a lot of pre-COVID numbers on the economy. So we're really, there's a lot of pressure, not just talk, but pressure for the government to raise rates. There was a lot of talk about transitory inflation, kind of like short-term, like just kind of inflation due to our like certain things. That word is going away, and now they're talking about real inflation. So the Scotiabank predicted 8 rate hikes in the next 2 years. I don't think it'll be that aggressive. I think that, again, once we start seeing 1 and 2 and 3, people will get the message and correspond accordingly. But I think most of the banks are generally between 4 to 8 hikes within the next 2 years. Now, generally a hike is 25 basis points. So let's say I have some rates today at around 1%, 4 rate hikes would push it to around 2%. Okay. So that's kind of where we are. But again, now we're talking about new variants coming out of Africa and all these different things. So as much as there's pressure to raise rates, there's also pressure to decrease rates. Frankly speaking, I think that a lot of people are going to go on vacation, whether they go south or they go to a cottage with friends, with family, and everyone is going to come back after the vacation, and it's just going to be a shit show. Like, I just think that that's going to happen, and I think we're going to see a spike of cases. I think that might actually result in some shutdowns or slowdowns, so that will slow rising inflation. So you've got a couple of competing pressures.
Okay, so when we talk about interest rates going up,
yes,
if someone was to come to you, and I think this is a really good question because
yeah,
I know a lot of my clients have this question in mind. If I go variable and the interest rates go up, how does that affect what I'm doing? How does it affect my investment? How does it affect my payments?
Right. So again, pillar number 2, it depends. So the first thing is people think that their payments are going to skyrocket. And the reality is, your payment could go up, but it shouldn't be a material amount. And when I say that, I mean, to get a mortgage now, generally, you need to prove that you can afford the mortgage at 5.25%. And most variable rates are around 1.2, 1.3, 1.4. So you've proven to the banks that you can afford 5.25. If your rate goes from 1.2 to 1.5, it shouldn't have a material impact on your lifestyle at all. But the second thing is, again, it depends. Some lenders, if the rates go up, your monthly payment will go up 30, 50, 100 bucks, whatever it is, depending on how big the mortgage is. But other lenders actually have variable rate type of products where your monthly payment stays the same. And it just slows down the amortization a little bit. And without getting too technical, from the consumer's point of view, a lot of consumers are concerned about managing their cash flow. Oh, well, my mortgage payment is $2,000 a month, but what if it goes to $2,800? There are many lenders that if you start at $2,000 a month, it pretty much stays for $2,000 even if rates go up. Whereas other banks, your payment could go up to $2,100, $2,200, $2,400. So that would be part of the conversation of like, you know, this bank has a lower rate, but their payments are more stable, or their payments might rise. This bank has a slightly higher rate, but their payments are pretty much going to stay the same for the next 5 years. A lot of consumers would migrate to a lender where the payments are much more stable, even with a variable rate mortgage. And I know that doesn't necessarily make sense, but the point is you could get a variable rate mortgage that has a stable rate for the 5 years.
Okay, that sounds great. And I'm sure, I know personally I get that question all the time, which I'm not a mortgage broker. I usually tell people call the mortgage broker, ask the mortgage broker for their opinion, and then go from there. And they come to me as if I'm the mortgage expert. I'm not a mortgage expert. I refer to the experts when I need to refer to the experts. It's the same thing when you see a house and you see foundation that could be cracked. You can see it. You might be able to say, I think there might be a problem, but you are not a contractor. You can't say that I know all the solution, I know exactly what's wrong. You have to bring an expert in, and it's the same thing when it comes to mortgages. That's why I had Elan come chat with me today, and it's because in the industry, he is known as a leader in the mortgage world, and I couldn't think of someone better to come in and talk to my clients and my world about what it's like to get pre-qualified, what it's like to get a mortgage, and what are the rates looking like in the future. Once again, it's Elena Saradidis, and I'm very glad I had Elan with me today to talk to you about mortgages.